my phone so I can keep track of the time, because I'm not a fan of going long and holding people any more time than they feel like they need to be. So I'll just kind of put that over here and I'll check it every once in a while. I don't even know where to look, if I should do that or not, or just look at my computer. Maybe it doesn't matter. Let me go ahead and get let's share my screen here. I've got a PowerPoint that I'll use. This information is also on my website. And now, oh, that moves. There we go. So you can find it there as well. We've got a couple of handouts here in the office, and we're just packed here. There's almost no room for anybody else in the office here. Just kidding. But it looks like we've got several online. So I actually changed up my presentation just a little bit from what I had originally planned. It's a little bit beefier. I don't know the experience level of who we have here listening. Whether I imagine we've got people that are just brand new within the last few months into the industry of real estate, all the way up to 30, 40 years of experience in the industry. So some of this is going to seem a little bit rudimentary to some of you. It's maybe brand new to others. And then hopefully we can get into a little bit additional, some of the less common deductions that people take advantage of. Sometimes they're not eligible for them. Sometimes they are, they just don't know about them, or they don't know how to take advantage of them. So let's go ahead and get started. Again, there's my information. You can go to my website, utahrecpa.com. You can email me. My phone number's there as well. But yeah, let's just get going. So one of the things that I find with especially brand new businesses, and even some that have been around for a while, they're just not very organized. And it's one of the biggest hurdles that I find in even deductions, finding deductions and making sure that you're taking advantage of everything that you possibly can. And so we just threw this in here real quick. Build yourself a pretty good team around yourselves. You're not experts at everything. I'm not an expert at everything. I do really well with accounting and taxes. I don't do well with spelling. That's my wife's for. No. But if I've got legal questions, I go to I'm going to ask a lawyer. If somebody asks me a legal question, I say, here's kind of what I've heard, but you know what? You got to go talk to a lawyer friend, or if you've got a lawyer on retainer or whatever that might be, go talk to them. They're the expert in that category. Get good mentors, coaches, those types of things. They are extremely valuable. Understand best practices, create a business plan, and set goals. Put it in writing. When I first went out on my own 17 years ago, spent some time on my own, I did not do that. And it was a big hindrance for me. Anyway, so do those things. Now let's jump into really what I am here for. This is just to get us thinking and get us started. I'm not going to go through all of these. These are common deductions for just business in general. I threw some in here that may be specific to the industry, real estate professionals or real estate agents. The Internal Revenue Code actually says it is deductible if it is ordinary and necessary to your business. So I often have people come to me and say, can I just get a list of everything that's deductible? And I go, well, what business are you in? Right? Because it actually changes from business to business. And I'll throw out an example. A general contractor would need a backhoe or a skid steer, right? An accountant does not need one. It's not ordinary and necessary to an accountant's business to have a skid steer. Therefore, would not be deductible for me, but would be deductible for a general contractor. So it's really hard to just tie down a list of deductions. So I fall back onto, is it ordinary and necessary for your business? Is it an ordinary deduction for real estate agents? And is it necessary for you to have that expenditure for you to be able to run your business? That makes it ordinary and necessary, therefore it is deductible. And if there's some things that you're wondering, if maybe not, We can try to actually structure it within the confines of the law and ethics to make it something that could be deductible if we structure it correctly, but it may still have the purpose that you're intending on that. So I just threw in a bunch here. Certainly this is not a comprehensive list, but it's just to get you thinking, right? So let's go through some of the ones that are actually more common, that we use quite a bit. Meals and entertainment. I see this a lot, right? Now, they recently, back in 2018, changed the deductibility on meals, what meals are deductible and what aren't. They changed it a little bit. So here's just a little, this is what you need to have for a meal to be deductible. It has to be with a current business customer, consultant, similar business contact, or even a potential one, right? You can definitely take someone to lunch or dinner. If you are trying to, for marketing, for clients, for whatever it might be, as long as they're potential or current client, consultant, or similar business contact, has to be in connection. Well, if it is in connection with entertaining a business contact, when the meal is separately stated, you can take the deduction for the meal. This is one of the big changes because entertainment expenses, purely entertainment expenses, are no longer deductible for businesses. For tax purposes, we'll still put it as a deduction on a profit and loss statement, but we're not going to have it. Unfortunately, we can't deduct it when it is for tax purposes. Meals purchased for employees, working overtime, lunch ordered for staff meetings, those are deductible. Now, one of the things that was nice for the last 2 years, including 2022, is meals and beverages from restaurants are actually 100% deductible, whereas they used to be only 50% deductible. That goes through the end of this year. So that's actually really nice because generally it's been, you take someone to lunch, you're gonna deduct 50% of the ticket, right?
Go away at one point altogether, like you weren't even allowed to deduct?
So I don't know if you remember, if you heard that question. The question was, did the meals deductibility go away at one? I don't remember it doing that. I've been around for 20 years and I don't recall it ever not being at all deductible. Now where that may come from is if you are by yourself, bouncing between appointments, you didn't have a client with you, that's not a deductible meal as per the Internal Revenue Code, right? Because you don't have anybody with you. It's just the IRS says, well, you were going to eat anyway. Yeah. Right? There was no business purpose there. So those types of meals would not be deductible. Make sure you're eating with somebody and you're discussing business is what I would say on that one. Okay. And that's pretty general. I think that's known by most people. How about personal use of your business use of your personal vehicle, right? We run into this quite a bit. Most of us don't have multiple vehicles for ourselves. We might have multiple vehicles for the family, but you drive your vehicle into the ground in real estate, right? That is just what happens. But you also use the vehicle personally. Therefore, it's a personal vehicle, but there's a lot of business use to it, and it could be the majority of what you have. There's 2 methods for taking a vehicle deduction for the cost of the vehicle, but both methods require a mileage log. You got to keep a mileage log. You can reconstruct these if you have to. If you haven't been keeping a mileage log, reconstruct one the best that you can, and then moving forward, keep a mileage log. It's got to have the date, the miles driven, destination, purpose. There's apps that'll do that. Most of you probably use some sort of an app that tracks every trip you go on, and when you're at the end of the week or whatever, it says, hey, was this a business or personal trip? And you swipe it and tell it what it is. Gives you a nice print. Those are great. The first method is the standard mileage method. This is just simply based on mileage, right? You get a standard rate per the number of business miles you have. Now, this is the second year in my career they've actually made a mid-year rate change. And this is not on the printout or on my website, but I did add it to my PowerPoint here. So it was 58.5 cents a mile. That is still in effect up until June 30th. July 1st through the rest of the year, it switches to 62.5 cents a mile. I'm like, are they gonna change it again? Because I know gas has gone up more than whatever percentage that is, 8% over this year. So that's ridiculous. But at any rate, they're trying to accommodate us to some point, which means that when you turn, if you're doing the standard mileage rate, you need to keep mileage from January 1st to June 30th, July 1st through December 31st, so that we can take the correct amount of deduction on your tax return. And this can be, I know, I've had clients, I think generally real estate agents are in that 25 to 30,000 mileage range. Sometimes more, sometimes less. I've seen as high as legitimately 65,000 miles one year. It was crazy. Not a real estate agent. He was in a rural area fixing phones, but he legitimately gave me his mileage log. It was 65,000 miles. And by the way, did not trigger an audit. Some people would be worried about that, but it didn't. No, I'm not as worried about audits as most people tend to be. The audit rate, side note, is about 0.25%. So it's really, really low. Not that we want to play the audit roulette. Right? We want to do things right just in case there is an audit. Then we don't have to worry about it. Now, the cost method per vehicle and is the second method for deducting vehicle expenses. Again, mileage log is required because you've got to establish the percentage of the business use of your vehicle. If it's 100%, it's 100%. Mileage log is going to push that out. If it's 50, then it's 50, right? And the mileage log will show that. Now, if you own your vehicle, what you do is you take this percentage, right? Business miles divided by total miles gives you a percentage of use, and you're able to take that percentage of use of cost. I want to make sure I'm not running long here, getting into some of these ones that you may not know as much about. You can take that percentage of the cost of the vehicle as a depreciation, right? If you finance a vehicle, that percentage of the loan interest. If it's leased, that percentage of the lease payments, that percentage of the insurance, repairs and maintenance, fuel, taxes, licensing. You do one method or the other. And what's important here is you can't bounce back and forth with the same vehicle. You got to remain consistent. If you buy a new vehicle and the first year you use the mileage method, you have to use the mileage method for as long as you own the vehicle. If you start with the cost method, you got to use the cost method for the rest of the time that you own that vehicle. Just have to be consistent. You get a new vehicle, you can choose a new method. What I like to do with my clients when they get a new vehicle during the year, one, I like them to contact me prior to getting a vehicle, just so we can talk about it a little bit. And then we can make that decision at tax time and say, how many miles did you drive? Which one is going to be best over, let's say, a 5-year period.
One that you find is better than the other?
What's that?
Is there one that you find is better than the other?
It really depends. And I know that's like a scapegoat answer, right? But here's what it depends on. If you have a fairly inexpensive vehicle and under 6,000 pounds, it's actually an important one, it's great gas mileage and is low cost of maintenance, and you drive a ton of miles for business, the mileage method will be far superior. If you have an expensive vehicle, that's, let's say, a truck that's over 6,000 pounds, you don't drive a ton of miles, but even though you may use it a lot for business, you don't drive a ton of miles, the cost method is going to be your best bet. That's kind of the minimum threshold. The cost method is the minimum threshold. You're at least going to be able to recoup your costs of your actual costs. But if you drive a ton and you have a low cost vehicle, low maintenance vehicle, as far as the cost of maintaining, your standard mileage deduction can exceed the actual costs of running and maintaining the vehicle and the cost of the vehicle over the time that you use it. So it just depends. I often see, I see a lot of mileage in real estate, just because if you're driving 30,000 miles a year, your deduction is going to be, what is it, like $18,000 every year for 5 years. And just the quick math tells me that's 80,000, right, at least, over 5 years. Where if you bought a $40,000 vehicle and spent 15,000 in fuel over those 5 years, it's probably more than that now. Your mileage deduction is going to be more than the cost of the vehicle, plus the fuel, plus the maintenance and everything. So it can be better, but a mileage log is required. So it just depends, unfortunately.
I use Mile IQ. If nobody up there has an app, it's a really great one.
What's that, Mile IQ? That's the one I see used more than not.
Yeah.
It is a great one. Thanks for pushing that out. It's a good one. It's Mile IQ. What is it, like $5 a month if you have a
Just like a
number?
recurring yearly subscription.
Oh, do you?
It's $60 a year.
There you go.
So, yeah.
Yeah, so $5 a month if you do a yearly one. And it's great for the accountant because
Yeah, it's good.
you just give me that and it tells me what your total miles were for the year, which we have to have, and what the business portion of those mileage is. So it's wonderful. Here is a newer deduction. This one actually came around in 2018 with the big tax restructuring back with the Trump administration. It's called the qualified business income deduction. This is a great one. It is basically a 20% haircut. You just get a 20% deduction. Okay. And the intent was to help out small businesses. So you go along, you have your 160,000 in commissions, you've got we find $60,000 of deductions, whatever it is, you got 100,000 in net income through the business, you get a $20,000 deduction. Just yours. Okay. There are some limitations on it, but what the nice thing is real estate is, I believe, not. Okay, I got this. Yeah, realtors are not considered a specified trade or business. There's accountants are. So we have these limitations that come into play. You guys really don't have these limitations until your joint filing net income is over 340,000. And then there are some limitations, but I don't find that those limitations really hurt real estate agents at all. So it's a great deduction. And if you've been in the business since 2018, you should have seen it on your individual tax return. That's where the deduction is taken. But it's a great one. It's just one to be aware of. It's just awesome. Just awesome. I don't know if there's any questions out there on that one. If you've got questions, I don't know if you can raise hands or unmute yourself and yell at me if you've got questions. That's fine as well. But I'll hopefully leave some time at the end for questions. Let's go to the home office deduction. This is one that is commonly used. It became more used. I don't know if it was that much more used during the pandemic, but it is one that is commonly used. The home office deduction. If your primary place of business is an office at home, a bedroom, a spare bedroom, or even part of a room that you can distinguish as a workspace, and you use it exclusively for business, so it can't be your living room couch, right? Can't be your dining room table, because hopefully you watch TV and eat dinner, right? If you don't, we have problems, right? So it needs to be an area that is exclusively used for business. Now, some people may say, I'll say, where's your office? You go, my car. And I go, yeah, I know as a real estate agent, you're in your car a lot because you're going to showings, you're going to see appointments, whatever it might be. Well, where do you do your administrative work, right? Where do you is it a CMI? I can't even remember now. CMA. Where are you doing that? Where are you writing up contracts? Where are you, buying office supplies on your computer? Where? At home. Okay. Right. This is where you do most of your general administrative work. We can say that is your office. Just because you're in your car 80% of the time going around showing appointments or whatever it might be, that doesn't make your vehicle your office. You do still have an office. We can establish one in the home, and you can have more than one office. If you rent a space here, which happens, I don't know if you do that a lot here with your agents. maybe you're here for the conference room availability or other things like that, but you still do a lot of your work at home. You can have two offices. You can deduct the rent for here, and you can potentially still take a home office deduction. And it's all based on square footage. It's similar to the vehicle one. You take the square footage of your workspace, square footage of the home, do a little math, gives you a percentage, and you can apply that percentage to a lot of your housing costs. If you own your residence, you can take that percentage of what it costs you to purchase the residence, depreciate it. It's not a big depreciation one, but it's a little bit there. You take that percentage of mortgage interest, property taxes, homeowners insurance. If you rent, you get that percentage of your rent or of your renter's insurance. If you do either rent or own, you get that percentage of your utilities, repairs that affect the home in general. HOA dues, yard maintenance, if you regularly meet clients at home. If you don't, yard maintenance, we got to throw out. But you get a nice little home office deduction. Now, I'll have people say, well, I have got a room at home, but I put in shelving and I painted it and I put in some decor and I've got all of these other things that are specific to just that room. Those are 100% deductible, even though it is your home office. And the reason is because it's exclusive to your home or to the home office. Vice versa, they may say, hey, I got $30,000 in new cabinetry in my kitchen. I go, well, is that your home office? No, well, then none of that would be deductible. If you got a new roof, a new AC, things like that, that percentage would still apply to those types of repairs. So the home office is really important. It's a nice one. We take it a lot. And then there's something else that I throw into the home office, the importance of establishing a home office, and that goes back to the mileage for your vehicle. Because commuting mileage is not business deductible. Business location to business location is deductible as far as mileage when you're doing your mileage log. If you have a home office, it's a business location. Anytime you leave your home to go to a showing or to meet clients or whatever it might be, the mileage is deductible. If you don't have a home office, your trip from your home to your first appointment or to the office here, it's a commute. Technically not business. So home office deduction it's great for the actual home office deduction, but it also helps establish mileage, right? If you're driving 20 miles to your first appointment and then home again after meeting with people during the day, you want that 40 miles that day to be business. Well, you need to have a home office. Establish the home office. Even if the home office is small, we want one so that we can do this as well. It just helps out. Okay. What are we doing on time here? Okay.
Doing really good,
I'm busting through this. This is like drinking from a fire
for
hose,
sure.
right? It stings a little bit because you get some up your nose. Most of it goes right by you, but you take a little bit. Again, you can go to my website. All of this is on there. You've got my email, my phone number. I'll flash that again towards the end. Shoot me an email, send me a text, whatever. That's fine. If you've got questions, that's great. I get this question a lot. Should I be an escort? Because people hear about it. Should I be an escort? I go, well, I don't know. It depends. Right? A lot of this is, it depends. S corporations can be great. I don't know if what I would recommend, and again, I'm not a lawyer, for tax purposes, I would say go out and begin at least establish an LLC. They're easy to establish, they're inexpensive to establish. I don't know if are you an LLC?
Yeah,
Escort?
LLC,
Straight up,
straight up.
LLC.
straight up, no status, escort status.
I actually don't know.
Most likely not. If you don't know, you're most likely not an escort, which is great. You go out and you get your LLC established, and what that does, it doesn't necessarily change anything that is deductible, because you're actually, as a single member LLC, you're treated as a sole proprietor. That's the same as not being an LLC, you're just not working under your social security number. LLC, I like it. One, it establishes a business entity, that's great. It doesn't change what is or what's not deductible. All the same deductions apply as a sole proprietor as to a single member LLC. So it doesn't change there, but it does establish a business entity, and it gives you some potential to do an Escort status in the future. Okay, so let's just run through a couple of quick things here. And let me say this. If you're an LLC and you make an S corporation election, and what we call an S election, you don't become technically a corporation, an S corporation. You're just allowed to use the rules of an S corporation like on your LLC. And how why they do this is an LLC does not have a tax return. An LLC, a single member LLC, you've probably heard the terminology disregarded entity. It is disregarded. It does not exist for tax purposes. It exists for legal liability purposes and all of those types of things. But an LLC does not have a tax return. A single member LLC prepares a Schedule C, which is for a sole proprietor. A multi-member LLC files a partnership return. So there's no LLC return. And so what the IRS has done is they've said, because we don't have one, you can kind of pick and choose what you want to be. Do you want to be a sole tax as a sole proprietor? And there's reasons to do that. Or if you want, we can make an election. It's a very simple election. It's an automatic election, and we can even do it late. And we can say we want the LLC to be taxed as if it were an S corporation. And then you take all the S corporation rules. Now, generally, there's a 75-day time period at the beginning of the year or the establishment of your LLC to become an S corporation. You can do it for any year you want. If you're past at 75 days, we can make what's called a late election and bring it all the way back to the beginning of the year, or the beginning of the establishment of your LLC if it was done after the beginning of the year. And be treated as an S corporation. Now, real quick, the reason I said it depends as to whether or not someone may want to be an S corporation or not is there are some disadvantages to S corporations. There's an advantage, one big advantage that we look at as far as tax professionals. You can save money. There's a potential of saving money as an S corporation versus being treated as a sole proprietorship or even as a partnership. And here's the real quick skinny on this. All of your net income as a sole proprietor or an LLC taxed as such is subject to what we call self-employment taxes. All it is Social Security and Medicare that if you were a W-2 employee, you would pay. And your employer matches. Most people don't even know that their employer matches Social Security and Medicare for their employees. Comes at 15.3%. Well, as a sole proprietor or as a partner in a general partnership, if you are an active member of the partnership, all of your income is subject to up to the Social Security limit of like 140,000 or something like that, is subject to Social Security Medicare taxes. We call it self-employment tax. It's 15%. If you're an S corp, your earnings from the S corporation are not subject to Social Security Medicare taxes. So that's 15% potential savings on that portion of the income. There are some disadvantages to an S corp. So there are potentially quite a bit of tax savings that can come through an S corporation, but there are some disadvantages. One is that you have to pay the officers, which are the owners, that's you, of the S corporation, reasonable compensation in the form of the W-2, which pays Social Security and Medicare taxes. So we really don't look at S corporations until your earnings are over what would be a reasonable compensation for a real estate agent. And those vary. I've looked at some statistics, they say it's 40,000, and I've seen others that say it's 70,000. Somewhere in that range is a reasonable wage for a full-time real estate agent. Some of you are probably making 200 grand or more. just because your business is making that doesn't mean if you're an S corporation, you have to pay yourself $200,000 W-2. I don't ever go over 90,000 because you start to lose it. And I think that's reasonable. I would say less than that is probably justifiable. We can't get greedy and call it 12,000, right? If you're working full-time, nobody's going to work a full-time job for 12 grand a year, right? It's what you'd have to hire somebody at. So we find this reasonable salary, which, you know, you got to go out and process payroll now. I recommend Gusto. They're easy. They're good to work with. They're a national company. They do everything for you at a nice, you know, monthly. It's not too expensive. So that's one drawback. So if you were making 100 grand as a sole proprietor, you're paying about 15,000 in the self-employment tax. Well, let's say you went to an S corporation status and you paid yourself 50,000 W-2. You're still going to pay the Social Security Medicare on that 50,000, which is 7,500 bucks ish, but you're not going to pay it on the next 50. You just saved yourself about 7 grand in taxes. Now that gets offset. You lose a little bit of that QBI deduction that I talked about. So we do need to run a little bit of a scenario to find out if it's good for somebody tax wise, right? There may be legal reasons for doing that, but I let a lawyer help you decide that one. But for tax purposes, S corporations can save money. You do lose some of the entity's flexibility as a sole proprietor, as a partnership. You've got tons of flexibility. There's a little bit of strictness that comes with being an S corporation. You some more rules you got to follow. There's some additional costs and record keeping. One, you've got to go out and hire somebody to do your payroll for you. I would not recommend doing it on your own unless you're familiar with it. But you probably find somebody, Gus will probably do it for around 50, 60 bucks a month. And they do everything. They do all of the quarterly filings, they remit all of the taxes, they do the final year filings, all of that. So there is a little bit of cost that goes into it. And as I mentioned, you lose a little bit of the qualified business income deduction. But this isn't something I can just say there's a line above it and below it. What we need to do is do a little bit of an analysis of your total tax situation to determine whether or not S corporation status is something that would work for you and your business individually. But it's out there. Be aware of it. If if you've got somebody else doing your taxes and accounting, bring it up with them. Maybe you already have. Great. If you haven't, ask them about it. They don't know. This is something very, very common. So good. We'll move on from that. Retirement plans. This is something that a lot of people maybe don't look at, especially at the beginning of their businesses. Retirement plans can be good. There are retirement plans available for small businesses, for self-employed individuals. I've just thrown up a couple of the more common ones. There are some others. There's where you can do a ton in. But here's the two most common. One is called a SEP plan. It's a simplified employee pension plan. This is one where the employer, now if you're a sole proprietor, you're both employer and kind of employee, even though you're not a W-2 employee, but you're both. So the employer makes contributions. If you're an S corporation, the S corporation makes the contributions. You don't have any employee deferrals, okay, or employee contributions, but they're very simple. To set up, these are the plans that I see most often at the very beginning because they're so easy to set up. They're low cost. And if you are the only owner and you don't have employees, we don't run into any issues with having to contribute to an employee's plan. Because under a SEP plan, the employer must contribute to all eligible employees, and the eligibility under SEP plan is very simple. It's like 600 hours during the year. They don't have to be full-time, not even close. There's really not a lot of age restriction there. Now, you could put up to $61,000 into a SEP plan. Per year. Okay. Now that's limited to 20% of SE self-employment income or 25% of W-2 income. So if you're a self-employed individual filing a Schedule C, and you wanted to do a SEP for yourself, and you made $100,000, you can put $20,000 into a SEP retirement plan. Get a $20,000 deduction. Backs maybe the negatives of that, the money's tied up, just like 401k. There's penalties for pulling it out early, but you can. In a SEP plan, there are no catch-up contributions, which means if you're over like 55 or so, 50 years old, it's still just the basic 20% of SE income, self-employment income, or 25% of W-2 income. No, hopefully that's not bothering you, Mo, and it just go to voicemail. It's low cost, talked about that. Now, solo 401ks is another option that I see. And in this one, there are employer and employee contributions. Okay. Even if you're a sole proprietor or being treated as a sole proprietor because you're a single member LLC, you are considered both employee and employer, which means oftentimes through a solo 401k, you can contribute more, not in total, but you can contribute more if your income is under, say, 200, whatever, 40,000 or whatever it needs to be to get a full $61,000 in there. And the reason is as an employee, you can contribute up to $20,500 this year. If you're over 50, it's an additional $6,500. So you could contribute $27,000 if you're over 50 of what would be considered your compensation. Now, as a sole proprietor, it's the total compensation is both. I get that. If you're W-2, it splits out between the W-2 and then maybe S corporation earnings. So what you do here is you can, that same 100,000, I'll use the same example, $100,000 of income, and you're like, man, I don't need it all. I'd like to start putting something away for retirement. You look at the SEP and you go, you know what? I want to put more than $20,000 away. SEP, you'd be limited at 20 because 20% of SE income. As a solo 401k, you could say, I'm still going to put in the 20,500. But then I'm going to have my employer, which is oddly enough me, put in 25% of either my W-2 compensation or my net self-employment income. So that 100,000 turns into about a $40,000 potential contribution into a solo 401k plan versus a SEP, you'd be limited to about 20. And then if your income's higher than that, of course, you could go higher. If you're an Escort, it's based on W-2 income.
And doing that basically makes it so you don't have to pay taxes on that.
Right.
Okay.
Yeah, it's a deferment of taxes,
Sure.
right? When you start pulling it out later on in retirement, you're going to pay it then. But if you're able to defer taxes for 30 years on income, just the time value of money, I know that's kind of a nerdy little finance accounting thing to say. Time value of money, meaning the value of a dollar now is worth more than the value of a dollar 30 years from now, especially with 10.8% inflation that we're hitting now, right? So I would rather save a dollar now and pay on that dollar later than pay the taxes on the dollar now. It's kind of what that is. But yeah, you can take a huge deduction potentially and forego or postpone the payment on the taxes of that until you start pulling it out. You know, and for some people, a lot of people say, well, you're always going to be paying more taxes because if they're ever going to figure out our national debt and deficits, they have to raise taxes or decrease spending, and nobody in that out east is going to stop spending money, right? So they always say they're going to raise taxes. Well, the thing is your tax rate now may be higher than it's going to be in retirement. If you're making $200,000-$300,000 now, you're already in the highest tax brackets. Well, when you retire, you may not be pulling that. You don't need that much for retirement. And I know a lot of retirement people will say it's flipped, and that may be the case for a lot of us, right? If we're lower income now or mid-income, and when we retire, we're still middle income and rates go up, we will be paying more as a percentage later, but time value money still may save you money. And there's a lot of ebbs and flows in that one. When I look at retirement plans, I don't look at necessarily. Do we do this for pure tax reasons? No, I think that's a secondary reason because taxes change. Every single year they change. I would say contribute to retirement plans because you want to.
Yeah,
You want to have that retirement later, not because you're necessarily trying to save a buck on taxes.
and in real estate, we don't have anything, so this is great.
Yeah, this is good, because the other one out there is gonna be your Roth, right? I mean, Roths are wonderful. You don't get a deduction for a Roth contribution. But when you pull it out later, there's no taxes on the distribution. Even on all of the earnings from the Roth, from the earnings within that Roth IRA. And I didn't put Roths in here. But man, Roths are great. They're limited on how much you can contribute, and there's income limits, but there's what's called a backdoor Roth. You can contribute to a solo 401k or a SEP and then roll it into a Roth, but then you're taxed on the rollover currently, but you got the deduction. It nets out. My brother does it. He's a dentist. He's like, I contribute to my retirement plan, then I roll it over into a Roth because I avoid all of the income limits and the contribution limits. So there's ways to do it. He gets the deduction for the contribution, then he has to pay taxes on the rollover. They should net out to about zero. Doesn't hurt him, but it gets money into his Roth. So that later on, and there's an interesting story, sidestep. Theo, I think it's, oh, I'm almost running out of time here. I'm not going to tell the story. Because I want to do hiring minor children is one that I get asked about periodically. Can you hire your children, pay them, and have a tax benefit? Yes, you can. There's a lot of information in here. I'll hit a couple of the important points. The best deduction comes if it's, now one, it has to be 100% parent-owned business. Okay. To be able to hire your minor children and receive a bunch of the best deductions. What happens here is if you've got children under the age of 18, okay, once they, I think it's once they turn 18, no longer, I think that's right. I'd have to maybe check, it might be 19, but I think it's when they turn 18, you can pay them up to 18. If it is 100% parent-owned business, not taxed as a corporation, so not as an S corporation. You have to pay them by wages. You actually get them on W-2 payroll. They don't pay Social Security, Medicare on their wages. You don't have to match their Social Security and Medicare and wages, so you avoid the Social Security, Medicare taxes, which you'd be paying as self-employment tax. And they file, well, if they're above the standard deduction, they file a tax return. If they're below the standard deduction, they don't have to file a tax return on that W-2. But they get to take the standard deduction. So let's say you've got a 16-year-old that can actually perform enough services to earn $10,000 during the year reasonably. Let's take that $10,000. You pay it to them as a W-2, no Social Security, no Medicare taxes. They get a standard deduction of $12,800, whatever it is. They don't pay any federal or state income taxes on that. Where you've just taken that from your highest tax bracket that you're in, let's say it's 24%, and you're paying Social Security, Medicare, that's another 15%. Now you're up to 39%. And you're paying the state of 5%. That's 44% tax total on as far as income is concerned. You just moved $10,000 from a 44% cumulative tax bracket to a true zero. Okay. Of course, they have to be able to perform the work. They have to actually do the work. So you got to keep the right records, pay them a reasonable wage. You can't pay a kid $100 an hour to clean your office, doesn't work. But you can do this, and you can get a nice deduction if you got kids that are old enough, and you can force them to work.
They do unlicensed.
What's that?
They can only do unlicensed
True.
stuff.
True. Yeah, I mean, they're not going to be able to do.
Sure.
Yeah.
Yeah, they've got to be able to legally be able to do the work.
What's on the list of what unlicensed assistants can do?
What I would do is I would start with what do you have? I have a license for
Yeah, I know what you was.
there. And then anything else business related, you can have them do.
Yeah,
I think that, because that list is gonna be shorter.
Kids that I have.
What's that?
I have 2 teenage kids that I got hired.
Perfect. Yeah, I had a client, she had triplets, 3 boys. They were 16 and 17 when she was my client, and we put them to work. Legitimately, they kept all the records and it worked out great. Okay. Again, you can see this information on my website. And you can text me and ask me questions if you want, or shoot me an email. My information is right down the bottom. Just a little bit about the way I run my business. I'm not a once a year type of accountant anymore. I used to be. And the firms that I worked with, that's the way they work. I'm going to do your monthly accounting. And I'm going to do your year-round consulting and projections. When you've got questions, I want you to call me. It's built into my fee. I do it as a monthly fee. I do your bookkeeping as part of that monthly fee. I prepare your business and personal tax returns as part of that monthly fee. If you've got questions, I want you to call me, shoot me text, send me emails. If your clients have questions, right? I remember I had my real estate license for like 20 years.
wow.
I don't have it. I don't have it anymore because I didn't use it. But I parked it and had it. I remember going through the classes and they kept saying, we're going to teach you some stuff on taxes, but you're not legally allowed to give tax advice. That doesn't mean you can't give good advice. What it means is you got to come across a question that you're like, I think I know the answer. Let me give you a little bit of a feedback. With my clients, I'm okay with your clients giving me a call, or you sitting down with your clients, giving me a call, or shooting me emails or texts and saying, hey, we got questions. We got kind of a sticky situation here. We just want to make sure that we're covering all of our bases. We can walk through the tax scenarios. And that's what I want. That's what I want my clients to do. I'm accessible that way. Anyway, that's the end of my presentation. Any questions for those here? If you've got questions and you're on the Zoom call, you can get my information. Shoot me an email, send me a text. You can actually reach out to me through my website. That's fine too. Love to talk to you.
I have a question.
You bet.
Something that I think a lot of the agents will want to ask, do you know of anyone, or do you handle creating LLCs or escorts?
Creating an LLC is legal work. I don't do any legal work.
Okay.
I know you can create an LLC on your own.
Sure.
It's very simple to do. My hesitation there is you need an operating agreement.
Yeah.
Right, because the operating agreement governs, and that's actually where, according to people I've talked to, right, you need to have an operating agreement because that is what gives you the legal liability protection. Just having LLC filing with the state is not sufficient.
I find more often than not with our agents, they have not ever created any sort of entity to receive their commissions in. We pay it directly to themselves.
Social security number.
And I believe, but I want you to let us know the answer to this, there's a lot more tax savings with creating an LLC or an escort.
As corporation, yes, just having an LLC tax as a sole proprietorship, it's the same.
As just individual.
As just as a sole prop. But as a sole prop, you cannot become an S corporation. You can't make an S election as a sole proprietorship. It's not allowed. You have to either be a corp or an LLC to make an S election. So that's why I say, go out and set up your LLC. Go get it done, because it gives us that flexibility in the future. Because if you maybe you're killing it this year, right? But you're a sole proprietor. You say, man, an S corporation might save me $8,000 or $10,000 in taxes this year. And I get a call that says, hey, I want to make an S election. And I go, are you an LLC? And they go, no. I go, wow, that stinks, because we can't do anything for the income up until the LLC is established. Go get it done.
Yeah.
And then we can help out for the rest of the year, but you just lost out on that, the
Sure.
benefit from the first part of the year. I really don't have a lawyer that I give recommendations to. They're not very expensive to set up. Even if you use a lawyer, I think doing it on your own is like $72, but you miss out on the operating agreement. I don't trust myself to write my own operating
Yeah,
agreement.
sure.
Did you have the second part of that question?
No, I think you answered it.
Okay, just wanted to make sure there.
I had it. An accountant tell me that an LLC is worth it if you make over 30,000 a year. Is that like a,
Where he's going there is the S election. Okay, because just an LLC, a single member LLC. You can have the exact same deductions as sole proprietor, because remember, they throw out the LLC when it comes to taxes, and you are taxed as a sole proprietor anyway, fall under the exact same rules. But if your income starts to build, right, there becomes a point where taking your LLC and making an S election does save you money. Okay, 30,000 might be a little low, right? Because you have to pay yourself W-2 wages, and it's got to be reasonable. Probably going to be a 30,000 or more anyway. You're going to pay the Social Security Medicare taxes on that anyway. But once you get up to 60, 70, 80, 100 plus, man, S corporations can really truly save you quite a bit of money.
I do have a
For being
question.
taxed as well.
When you pay yourself, you know, you get your W-2 income and your payroll. You can actually use your other money, right? You don't just only get to use what you get in your.
As an S corporation?
Yeah.
Or yes, absolutely. Yeah, you have the right as the owner of the S corporation to the earnings of the S corporation. You're going to pay taxes on those whether you pull it out of the business or not. Yeah, so what I usually do is you'll get your monthly payroll or whatever, and then just do a distribution out of the S corporation of any additional earnings that are in there. And there better be, because we wouldn't be an S corporation if there wasn't, right? So yeah, so you would do a W-2, let's say every month. And then you just do another distribution, just transfer the money from the business account to your personal account. It's called a distribution of earnings. And you are absolutely entitled to that. And it doesn't even have to be.
File anything to do that, or can you just do it whenever?
You just do it. Yep. And that may be actually part of the operating agreement, which states that shareholders are allowed to do distributions upon, at whenever they want, on a whim. They can just do it whenever there's earnings in it. It's nothing formal. If you were a C corporation, you've got to go through a declaration of dividends and whatever, but C corporations, that's even hardly ever. But an S corporation, yeah, you can just do a distribution of earnings, just like as a sole proprietor, when you've got extra money in the account, you just transfer it over your business to your personal account. One thing else I did fail to mention, and it's vital, I should have probably said this right at the very beginning, keep your business and personal separate. Right? Don't commingle. One, it's a nightmare to do the accounting. You lose deductions because you're like, I think that might have been personal. I can't remember. It was January, and here we are a year and 3 months later trying to figure it out, right? Have a business account. All the commissions should go into there. Pay for all of your business expenses out of it. Transfer money to your personal account to do all your personal stuff. If you need some money for business, don't pay for it out of your personal account. Transfer money into your business account, pay for it, keeps things clean. And a lawyer will tell you the easiest way to go right through an LLC for they call it piercing the corporate veil is commingling of funds, not treating your business as a business, but treating it as you personally. Don't do that. That's vital, very, very important.
That's really good advice for realtors too, because I think they tend to think that commission I earned it, so they don't really think about it as a business and.
Right.
Yeah.
And and then there's always oh crud, I didn't transfer any money, I'm out, I need to buy groceries for myself, I'm at the store, business card, because that's where the money is. Avoid doing that if you can. It happens, great. I think there's leeway in there for a little bit of that. I mean, because it does happen, but avoid it if you can. Absolutely. Great. Anything else?
No, but this has been great. Thank you.
Let's shut it down. I mean, if other things come up, I'm happy to come give more deep dives into certain specific items.
Great.
So
We love this information, so thank you very much for coming.
hopefully put it back over there. You want me to just, I guess they'll shut it down over here, right? I'll just do a stop share and.
To know what your monthly fee is. Is it
Um,
different per person, per business, or?
It's a base, I start out as a base, $150 a month.
And does that include doing your taxes at the end of the
It
year?
does, yeah, so what that would include is the monthly accounting. So either you're gonna give me like a read-only access to your bank and your credit card if they can, or you're gonna send me your bank statements, credit card statements, hopefully every month. That way I can do the monthly accounting.
Do you do payroll too?
I don't do payroll.
Not the payroll.
And the reason I don't is because it's less expensive to go somewhere else. Honestly, it is. Go someone that does nothing but payroll. Remember that team I said, don't do things that you don't do well?
Mhm.
Payroll is something, if I did it, it would be, it's not cost effective. And I just don't, honestly, I don't like doing it. I'll just tell you the truth there.
Stay in your genius.
Yep, I want to be streamlined, so it's monthly accounting. Give you a P&L and balance sheet every month. And the nice thing about that is I'm in touch with your income. And if I've already talked to you, I know when I need to reach out to you instead of you thinking, do I need to call that Tyler guy again? Right? So I see it coming, I can reach out to you. The other thing in there, all the questions you might have throughout the year, I don't bill separately for, I tie it in. If you've got client questions, your clients have questions that you don't know the answer to, don't say, go find a guy. Say, I've got a guy. Right? Let's give him a call. Let's send him an email. Let's get this answered. That's built into the fee. Doing tax projections. The worst time to find out what you're going to owe for taxes is in March or April. It is the worst time. We want to do it maybe twice a year. In October, November, towards the end of the year, we want to do a tax projection. One, because you know what your income is going to be. So we can determine what your taxes are most likely going to be, get really, really close. You got 5-month leeway before they're due. And we've got a little bit towards the end of the year, if there's some planning things that we can do. Maybe you had a banner year, you're like, I'd like to put some money in the retirement plan. How much is that going to save me? We can talk about it then, get it done before the end of the year, because in March, it's too late. You've missed the opportunity. So that's built in as often as we need to. And your individual tax return, whether it's a joint filing with a spouse or your own, and the business tax return, whether it's part of your individual return as a Schedule C, or if it's a separate entity like the Escort version. All of that is built into my monthly fee.
I love that,
So
because I have two separate, an accountant and a tax guy, and I gotta make them talk at the end of the year.
we're talking before the end of the year.
Yeah,
Make them talk before
We
the
are, but still, it's kind of like, hey, I have to reach out to both, and so it's nice that you do both.
Good. All right, well,
Thank
anything
you.
else? We'll shut down. I think we went over time and sorry, everybody. It wasn't my fault. It was my fault.
No, you did great. We asked a lot of questions, so.
I'm gonna.
Well, thank you. Here's Tyler's information. If you want to get a hold of him, sounds like he does a fantastic job and knows our business because he's been a realtor. And so what better to have a CPA/tax guy that does all of, knows real estate. So, hey, you guys, enjoy the rest of your day. Thank you for coming. Hopefully we see you all at the service project today at 3.
Strawberry, these sounds yummy.
Yeah, for sure.
That's today.
We did 6
Yeah.
flats of strawberry jam.
You did?
Yes. Freezer jam.